Welcome to Innovation Dialogue. I'm Diana Ding.
My voice.
My story.
My dream.
Innovation Dialogue.
We are encouraged by their story.
Pretty busy week with conferences. I don't know if you guys have heard of Disrupt, but it's been a busy past few days. But yeah, for this panel, we're going to be talking about corporate investment arms and other areas that corporations tie to startups. But let's start out with everyone introducing themselves and explaining what you do.
Good afternoon. My name is Charles Fan, and I'm CTO of Cheetah Mobile. Cheetah Mobile is a mobile app company headquartered in China, but we have a very extensive reach outside of China with 80% of our users outside of China. Our total users is about 600 million unique users, and we specialize in Android utility apps as well as gaming and content apps.
My name is Grant Allen. I lead the global venture investing group for ABB, Asia Brown Boveri. We're a Swiss-based industrial conglomerate that operates in about 100 countries, $35 billion top line. What we have within our VC group is a $300 million platform that invests in companies that are strategically relevant to ABB, our parent company. We've done 26 investments since we were started in 2010 and put out about $50 million a year.
Hi, good afternoon. My name is Steve Mitzenmacher. I head up corporate development for NetApp. We're a $6 billion enterprise storage and data management company based here in Silicon Valley. Our approach to venture, we don't have a discrete fund. We do off-balance sheet investments, typically a late A, Series B, and similarly our goal is to assess new markets or strategic adjacencies through investments.
Hi, my name is Kiyotak Kumazawa. Good afternoon. I'm working for Hitachi, and Hitachi is, as like ABB, it's a conglomerate of a social infrastructure company, and we spent like $5 billion USD for all R&D, and around 10% or 20% of them is used for the venture capital funding and so on and so forth. But as like NetApp, we do not have any kind of dedicated capital firm. So each one of the group company is have a person who is in charge of those venture funding.
And so each corporate venture arm works very differently, is my understanding. But I'd be curious to hear from each of you if you're investing in startups that are synergistic to your business or if you're just looking for returns.
So I'll start. So we are more of the former. We also don't have a dedicated venture fund, but we actually have invested in over 50 companies over the last few years. And Cheetah Mobile itself is a relatively young company. We started in 2010, so we're about 7-year-old. We went public on New York Stock Exchange in 2014, and we were one of the first companies from China to venture outside of China. And since then, we've been investing in quite a few companies who are looking to do the same. And we are looking for leverage, either that they will there is a cross leverage between the users we have and what they need to do, and so that we can help them in their reach outside of China, or the users they have could have cross leverage to us. One example is a company called Musical.ly.
Know about them?
Yeah, I think most of you probably know them. It's a very successful company, and it was started, for those of you who don't know, it started in Shanghai. In fact, when I was working in Shanghai 10 years ago, the founders of Musical.ly were just working across the hall from me, and who have never been to the U.S. And then they started this service called Mamma Mia, which was a predecessor to Musical.ly, and Cheetah actually led the angel round of investments, the seed round. And in the last 2-3 years, Musical.ly has become a phenomenon. globally. So that's just one example of the type of companies that we invest in, and there is clearly we cheer for the independent success of the company, but there are also leverage that we can achieve. For example, the first year, the advertisement, the monetization on Musical.ly was actually done by the Cheetah team. We actually try to help them to focus on the core product features while we can help them with the advertisement. And that, I think, in turn benefited both companies.
This probably isn't the target demographic for Musical.ly. It's a social media app for tweens. So, but they're doing well, last I heard. So, if you could explain what your investment thesis is.
Not a lot of tweens out there. Okay. So ABB, we sell a lot of different things, from infrastructure gear going into power utilities, gas insulated switch gear, all the way down to bow thrusters for big boats, robots. We're the #1 robot provider in China right now, #2 globally, down into small electrification products, motors, drives, and other things that sit at the factory floor. So as I mentioned earlier, everything that I invest in has to have some strategic relevance to my business units, and we have 25 business units. But as I always tell my boss, it's never strategic to lose money. So I have both strategic mandate and a financial mandate. Any CVC, corporate venture capital group, that says they're out there only to make money is lying. I don't believe that that's the case. If they're out there deploying their capital from a balance sheet, or even if it's a dedicated fund, there has to be some linkage to the parent, or else they're not driving value for the parent with that dollar. So in my case, we're trying to find a medium between being a strategic object that we're out there trying to either pull through our products or help us see around the corner, what we call visionary eyes and ears deals, or we can specifically set up a future option or a hedge for our technology development. But again, we have to invest in deals that drive venture class returns. So that's why we always syndicate with best in class financial VCs, and we have to hit the same return metrics that they do. So again, you have to hit both sides of the coin and balance the two.
Yeah, I mean, for NetApp, for NetApp, investing is something that we do very targeted. So we maintain a portfolio, just a handful, 5 or so at a time. And really for us, I like that the term, the visionary eyes and ears, that we think about, the world we live in, and want to look at these, second order or even third order technology trends that may impact us 3 years, 5 years down the road, and use the investments as a way to track and understand how that trend's impacting. So we don't expect, in terms of our ground rules, things like the M&A hedge. We don't want to invest in a company that necessarily that we see ourselves buying in that 3 to 5 year time frame, which I think is different as an approach to other firms. And then in terms of our objectives, it's we just don't want to lose money. So if our goal is not to be a first quartile venture investor, but to be prudent with how we deploy capital, and ideally break even with the investments we make.
In Hitachi case, it is we are not pursuing any kind of ROI. We only purely try to get the business and technology, and we try to use those technology to enabling our other combined other technology to the market. So from those point of view, ROI, as I mentioned, is not necessarily accounted outside of the company, but within the company, it is very much pursued by each one of the business unit management and each quarterly basis. So it is tough within the company, but outside, it is not necessarily announced as like that way.
So someone brought up M&A. That's interesting, because that's something I wonder a lot is, would you ever buy these companies that you're investing in? It sounds like you wouldn't, but would any of the other venture arms or groups here consider that kind of thing?
I would agree. It's never the thesis, because if you're going in as a precursor to an M&A, you're going in with completely misaligned incentives. And if the business chooses not to exercise that option, you're left holding a fairly damaged asset. because you've signaled to the market that you have a strategic interest in something, and if you choose not to exercise, it signals that there is some fundamental issue with the underlying asset.
So driving up the valuation anyways.
But if we go into a company and by virtue of our investment, the business gets more exposure to that company and starts to really like them, and the business relationship gels, and we start selling a lot of, for instance, robots through them, and they decide to later pull the trigger and acquire it, I'm certainly not going to stop them. I'll also tell GE and Siemens, hey, you should check out the company and see if we can juice our returns. But it's never the core thesis. Right. My very first investment, though, with ABB, I did sell to ABB 18 months later. So whenever I'm asked this on a panel, I can't say that we never do it because we've done it.
Yeah, I mean, I would never say never as well if the rationale was there. But to the extent that we even try to prevent to that point of misalignment, other companies might try to tie an investment to a commercial deal. And again, you're, sort of by virtue of doing that, king-making that company, driving up the valuation. And so those, you don't want to incent the business unit to try to use the investment as a leverage point that serves them today when, again, we've set the primary goal as ways to think about the future. Again, I think other organizations take different approaches. I recently saw some data that talked about, I think in its history, Intel has acquired 12 companies that they've invested in. Google's acquired 5 or 6. Now that being said, those 2 companies are also some of the most prolific venture investors over the last 5 or 10 years. Intel invests in hundreds of companies, so just like the law of math says, it's likely they'll have to find it'll even randomly they'll end up needing to buy companies that they've invested in.
Right. At Cheetah Mobile, we have only made 2 acquisitions so far, and none of them were in our investment portfolio. So we have not done it, and it was not a target. Before Cheetah, I worked at the EMC. And I think they had a slightly different, depending on the initiative. For example, when the Flash came out, the EMC certainly invested in every company they could invest that had anything to do with Flash. So eventually they acquired a few of those. So it was another strategy, which is to have your reach across the board and get better visibility, and then pick the winners, hopefully, to acquire. So that was a different approach.
And we were on the other side of experiencing that painfully when we decided we want to acquire a Flash company and found that all of them had EMC's money in it.
Right. I certainly have had the investment in the company give EMC a leg up in the bidding war against the competitors when the acquisition comes.
So how do you deal with competition? I know that one hypothetical concern of some portfolio companies or startups is that if they meet with a corporate venture arm that's in their space, that some of their ideas could be taken. Or if they work with a corporate that maybe some of their ideas, even if they invest in this startup, could be taken in another division. How do you alleviate these concerns?
Well, it's a question I get all the time. It's, are you going to slow me down? Are you going to brain rape me and steal my ideas? Or are you going to signal to other companies that they don't want to acquire me because you're in it? Kind of this issue of, oh, they have money from ABB, therefore GE, Siemens, Schneider, Honeywell doesn't want to buy me. These are the top 3 issues I always get. And I think we have good answers to all of them. And to the specific problem about how we deal with IP contamination, there are some times where it is very close to our core, and I'll cordon off the diligence materials in just my team. I'll have some technical folks parachute in, but we're not getting into deep technical detail on that company, and it's separate. And so I can play as much of a vanilla VC as possible. It's just that I have this big company behind me, and they're funding the deal. But in terms of those, that data, that knowledge, whatever they've built, that stays separate. But generally, I invest in things that are not close to ABB's core. I invest in amplifying or enabling technology that we never want to own. And I think that's the best synergy of a corporate venture with a big parent behind it. So a company that actually was at TechCrunch yesterday presenting was a company called Soft Robotics. They have a soft elastomeric gripper that allows it to be very agile and pick up fruit and things that you don't want to damage. So it has a very soft touch. This is something ABB will never want to own. It's an end effector that just snaps onto the stuff we already sell. We have 300,000 robots out in the wild, and it makes them do more stuff, such as go out there and pick strawberries. So again, it's an amplifying technology. We'll work with them. By virtue of that investment, we sell a lot more robots. And by virtue of them working with us, they get the ABB brand, and it's a nice marriage. And there's no issue of contamination of IP or us stealing their idea. It's a piece of silicon that has air inside of it. Yeah.
Anyone else have thoughts?
Yeah, so Cheetah, all our investments were very early stage, either seed or Series A. And I think we are attractive to these companies because of the user base we have. We are the third largest app developer measured by users on Google Play. So for early stage mobile app company, having the optics of an access to the user base is attractive. And so I would say we were actually quite competitive in terms of being an investor into a mobile app company at an early stage.
In Hitachi's case, it's a little bit different. Unfortunately or fortunately, we do have enough researchers and doing many things. So usually, even though it is a very revolutionary, startup there, what they're doing is sometimes we do have, or many times we do have internal competition. So we create a firewall in between them, and we let them race. And whenever who is a winner, we're gonna using those technology. Say like 30-40% it's internal, and 50-60% is outside.
So how hands-on is everyone? I mean, I imagine if you work in the same industry, you could make intros or provide some other insight. How involved do you guys get with your portfolio companies?
So for us, every investment we do require a board observer seat, which is a unique position to play because as a board observer you're not supposed to talk. So at least amongst and you don't have any kind of sort of vote or governance. But yeah, certainly you want to be a good citizen and as a part of the broader relationship, do whatever you can. And though I made the comment that we won't do a venture deal tied to a commercial relationship, that doesn't mean that we'll try to prevent it. And if there's synergy there, we'll explore it. But the valley's the valley, and wherever you can be helpful, you want to try to facilitate that, whether it's brainstorming with a CEO around strategy, based on the experience that we have, making introductions from a business development perspective. Those all, I think, help build the relationships. And what you want to do is build a brand as an investor that shows you're a good citizen, because that's how you get in the door by reputation for the future ones that you want to do.
I was in financial VC before I came over to ABB, and our model is pretty simple. I try to do exactly what every good venture capitalist will do with your company in terms of accelerating your business, making introductions, giving you good guidance, and ideally aiming to be the first phone call that you make as a CEO. And then on top of that, offering access to a very deep R&D bench. We have 6,000 PhDs, having access to our brand and having access to our sales channels. So there's often this theme that corporations are kind of guilty until proven innocent, that we might be bad or somehow going to send out a signal that you might not want to work with another company. But I view it the other way. We will be the same dollar you could get from anyone in Sand Hill, and dollars are so cheap these days. I mean, it's just there's money sloshing around the valley. So why would you not, especially if you're in hard tech or going after tough industries like energy or robotics or advanced manufacturing or semiconductors, whatever it might be, why would you not want to have a company that's been doing this for decades and has a deep bench of R&D experts and has someone you can pick up and say, what are the pitfalls as I scale up this business with hard tech? We're not building apps. We're building real stuff here. So when I offer that to startups, that's a huge, huge differentiator. And now that AI and robotics are so in vogue, VCs are coming to us and say, what is your take on this deal? They're beating down our door to work with us because we've been making robots since 1974. So it's a nice flip of the script.
Right. So our founders are very young and very recent founders. So I think the offer we have to the company we invest in is we understand them as founders, and we try to be good investors in the sense that we help them when they need help, and we don't help them when they don't need help. And so even though we are actually full board members to some of the boards, we try not to over exercise our rights. But at the same time, for example, with the Musical.ly example, and we also invest in Nanigans, which is a ad platform, we actually form commercial agreement between the two companies, which is beneficial for both companies. So we actually do establish some of the business relationship with the company we invest in, while trying not to overly influence their business directions.
All right, looks like we're out of time, but thank you so much. Interesting to get your insight.
Thank you.
Thank you.
Thank you so much.